Today, we are diving into a really important but kind of complex concept in real estate finance, the distribution waterfall. Now, I know it sounds complicated, but stick with me. This is basically the hidden engine behind those huge property deals, and it's what decides who gets paid, when they get paid, and how much they get. Let's break it down. Okay, so picture this. You find an absolutely amazing real estate deal, but you've only got about a tenth of the money you need. So an investor comes in with $9 million while you put in $1 million, and you do all the heavy lifting. I mean, everything, finding the deal, managing it, the works. When you sell and make a massive profit, how do you split that money up? I mean, what's fair? This is the exact problem the waterfall structure was invented to solve. So, before we get to the solution, let's get really clear on who the two key players are in this game and the fundamental challenge they're facing. In these kinds of deals, you've basically got two sides. First, you have the general partner, or the GP. Think of them as the operator, the expert on the ground who makes it all happen. They usually put in a smaller slice of the cash, maybe 5 to 10%. And on the other side, you have the limited partners, or LPs. These are the investors. They provide the lion's share of the money. We're talking 90 to 95%. But they're passive. They're not managing the property day to day. So here's the million-dollar question, right? How do you make sure the GP, the person doing all the work, is motivated to get the absolute best returns for the LPs, the people who are putting up almost all the money? You need a system that doesn't just pay them a salary, but really rewards them for hitting a home run. You have to align everyone's interests.
And that brings us to the industry's really elegant solution to this whole problem, the distribution waterfall.
So what exactly is a distribution waterfall? Well, just think of an actual waterfall. It's a system for splitting up profits where the money flows down, in sequence, through different pools or buckets. And here's the key. One bucket has to be completely full before any money spills over into the next one. And each of those buckets has its own rule about who gets the money inside. Okay, theory is one thing, but seeing it in action, that's how this really clicks. So for the rest of this explainer, we're going to follow the money from a hypothetical deal step by step to see exactly how this whole thing works in the real world. All right, let's walk through the tiers. We'll use our example, a $10 million investment that, when it's sold, generates a cool $5 million in profit. So the cash is going to flow through three big stages. First, and this is crucial, everybody gets their original investment back. Second, the investors get a little something extra for taking the risk. And third, that's when the real profit gets split up, but in a very special way. The very first rule is simple, and it's non-negotiable. Before anyone even whispers the word profit, all the original money goes back to the people who put it in. So the LPs get their $9 million back, and the GP gets their $1 million back. That is the first bucket, and it has to be filled to the brim. Okay, once that's done, the money spills over into the second bucket. This is called the preferred return, or you'll often hear it called the pref. It's a really important step. It means the LPs, the ones who put up most of the cash, get a priority return on their investment before the GP gets their big payday. It's kind of like interest they earn for taking the risk. And a pretty standard rate for a deal like this is around 8% a year. So what does that look like in real numbers? Well, let's say our deal took 4 years. That 8% per year on the LP's $9 million investment, that adds up to $2.88 million. So out of our $5 million in profit, this entire amount flows directly to the LPs. All right, after everyone's got their initial money back and the LPs have received their preferred return, now we get to the most interesting part, the promote. You might also hear this called carried interest. This is where the rest of the profit gets divided up. But, and this is the whole point, it is not split 90-10 based on who put in the money. This is the GP's big reward for a job well done. Let's just do the math real quick. We had $5 million in profit. We paid out $2.88 million in that preferred return. That leaves us with $2.12 million. Now, this final chunk of cash is often split on a 70-30 basis. The LPs get 70%, or about $1.48 million, and the GP gets 30%, which is around $640,000. Now think about that. The GP is getting 30% of this profit pool, even though they only put in 10% of the original money. And this right here, this shows you the incredible power of the promote. Look, the limited partners did great. They made a return on investment of over 48%. That's fantastic. But look at the general partner. Because of that final 70-30 profit split, their ROI is a staggering 64%. That is the incentive that drives them to knock it out of the park for everybody. Okay, so the structure we just went through, that's a super common example. But you have to know that not all waterfalls are created equal. There are some really crucial variations and rules that can completely change how the money flows. You know, one of the biggest differences you'll see is the American versus the European waterfall. The American style calculates that big promote on a deal-by-deal basis. So a GP could have one huge win and get a massive payday, even if another deal on the same fund loses money. The European model is generally seen as more friendly to investors. It pulls everything together into one big pot. The GP only gets their big reward after all the investors in the entire fund have gotten their money back and hit the return targets. All right, here are a few other key terms you should definitely know. A clawback is a safety net for the LPs. It can actually force a GP to give back some of their promote if the fund ends up underperforming later. Cumulative pref just means if that 8% preferred return isn't paid 1 year, it doesn't just disappear. It rolls over and gets added to the next year. And GP co-investment is exactly what it sounds like. It makes sure the GP has their own money in the deal. We call that skin in the game. Okay, let's pull back for a second and talk about the bottom line. Why does understanding this structure matter so much for anyone who's even thinking about investing in real estate? This table really puts it all together. The LPs put in $9 million, and they walked away with over $13.3 million. That's a fantastic outcome. But the GP who only invested $1 million got back over $1.6 million. Now, this isn't unfair. This is the agreed-upon reward for their expertise, their risk, and for executing a plan that made the whole deal a success in the first place. And that really gets to the heart of it. This whole structure, with all its tiers and hurdles and rules, it isn't just a bunch of fancy financial engineering. It's the fundamental economic engine that aligns the interests of the people with the money and the people with the expertise. It's what makes the entire commercial real estate world go round. So, if you're an investor, what are the red flags? Well, be careful with deals that have a really low preferred return rate, because that means the GP gets to their big promote payout much faster. You should definitely watch out for deals where the GP has no skin in the game, no cash of their own invested, or where the pref is non-cumulative. And as always, if the legal agreement is super confusing or unclear, that in itself is a huge red flag. We've seen how the waterfall structure incentivizes a GP to go after huge returns, right? It pushes them toward projects that can clear all those hurdles and deliver that big promote at the end. Which kind of leaves us with one final big question to think about. How does this powerful financial incentive, buried deep inside investment documents, ultimately shape the buildings, the neighborhoods, and the very cities that we all live in?